Welcome to the first webinar discussion of our Spring 2022 Global Economic Governance Book Talk series, hosted by the Boston University Global Development Policy Center. The Boston University Global Development Policy Center is a university-wide research center that works to advance policy-oriented research for financial stability, human well-being, and environmental sustainability across the globe. My name is Bill Kring. I'm the Executive Director of the GDP Center. I have the pleasure of introducing our speaker today, Stephen Kaplan. China's overseas financing is a distinct form of patient capital that marshals the country's domestic resources to create commercial opportunities internationally. And its long-term risk tolerance and lack of policy conditionality has allowed developing countries to sidestep the fiscal austerity tendencies of Western markets and of multilaterals. Globalizing Patient Capital, the political economy of China's finance in the Americas, a new book from Dr. Stephen Kaplan, finds that China's patient capital endows national governments with more room to maneuver in formulating its domestic policies. The book evaluates the potential costs of Chinese financing and raises the question of how Chinese lenders will react to developing nations' ongoing struggles with debt and dependency. Globalizing Patient Capital has significant implications for the rise of China and Latin America, offering new insights about globalization and showing the costs and benefits of state versus market approaches to development. Dr. Stephen Kaplan is an associate professor of political science and international affairs at George Washington University and a faculty affiliate at the Institute for International Economic Policy. He is also a current global fellow at the Wilson Center. His research and teaching interests focus on the frontiers of international and comparative political economy, where he specializes in the political economy of global finance and development, China's foreign investment in developing countries, and Latin American politics. So today, Stephen joins us to discuss his new book in the political economy of Chinese finance in Latin America. He'll present for about 30 minutes, at which point we'll open up for a discussion. Before turning it over to you, Stephen, I want to mention that this webinar is being live streamed on YouTube, so recording is immediately accessible to everyone. Please use the Q&A box located in your Zoom menu to ask questions. Please also provide your name and affiliation so that I can refer to you when I introduce your questions as moderator. And we'll take questions following Stephen's remarks, but please feel free to enter your questions at any time. Thank you. And now over to you, Stephen.
Thank you very much, Bill. Thank you very much to Kevin, and thank you to the GDP Center as well. I'm very excited to share my work with you today. I'm sharing my screen now. Okay, so this talk is based upon my book, Globalizing Patient Capital, as you just heard. And we can start with the following graph. Right? This graph essentially looks at global finance, cross-border banking activity throughout the 2000s to current day. And effectively what you see is, compared to other regions like Africa, where China's financial presence and lending occurred in greater volumes earlier, in Latin America, we had primarily a trade relationship up until the global financial crisis. There you can see in this graph, as Western powers began to withdraw from Latin America, but also the globe, simultaneously, we see China expanding its global finance to become one of the world's top creditors. It's a top 5 global banking creditor now. This coincides with sort of a more assertive foreign policy by President Xi, who's promised to make China a leading world power by 2050, blazing a new trail for other developing countries to achieve modernization, with new options for countries who want to speed up development while preserving their independence. So what I want to look at today specifically, China's global finance, right? The implications of sort of that global finance, and particularly asking the question, is China's finance unique from other forms of finance? And if so, what are the economic repercussions of that? What are the political repercussions of that? So first, let's look at sort of the Americas relative to the rest of the world. And you can see that loans from China's policy banks, right? Those are the development banks that are doing overseas banking activity. The majority of their activity is in the Asia Pacific, not surprisingly, but you also see, along with Africa, that a lot of activity has been dedicated to the Americas as well. And in looking at this Chinese financing, I want to compare it to Western financing, but particularly within a literature, scholarly literature, that suggests, right, that as sort of global finance comes into countries, and countries are more reliant upon external financing, right, effectively, states will have less room to maneuver. Why would that be? Well, the idea stemming from the Mendel-Fleming trilemma is that when there's lots of global capital mobility, governments will face a trade-off, right, between policy autonomy, right, central bank independence, greater fiscal space and maneuverability, and financial and exchange rate stability, right? But the key assumption of this literature is that capital is private and short-term oriented to some extent, and is likely to exit, right, when countries are faced with financial instability or currency depreciation, right, because that erodes their profits. So the notion is that this capital exit threat is going to compel governments to raise interest rates or constrain fiscal spending. What I do by bringing China into this mix, state-led financing, right, or patient capital, is to think about how does it change that trilemma? And essentially what I argue is it eliminates this capital exit threat and allows for greater fiscal space, greater policy maneuverability. Why? Well, capital controls have limited overseas private investment from China. It's restricted the ability of residents to invest in financial assets overseas. So it minimizes short-run financial connections between China and the rest of the world. And you get more of this long-run patient capital emerging from China. So I asked the question earlier, right? To what extent is China's financing unique from other forms of credit? Well, I think it's unique in the following ways. One, its long-term maturity structure, as I just mentioned. Certainly other bilateral lenders will lend for a long period of time, but China's unique in its scale, right? Other bilateral lenders haven't matched the scale of China's financing. Also, compared to sort of private creditors, for example, in Latin America, often private creditors have maturities, 3, 4, 5 years. Average maturity of China's loans tend to be about 17 years. This reflects, of course, the infrastructure nature of this global financing. Also, however, I found that China's financing tends to be more risk tolerant, right? Meaning China's policy bank investors are more likely to stay with their investments through good and bad times. Now, why would they do this? Well, the argument here is too that China sort of wants to maximize its firm's market share internationally. The way it can do this is essentially using Chinese financing as a comparative advantage, right, to enter into markets, right? They can help firms gain access to cheap assets, build market shares, improve key logistical skills such as marketing, distribution, and local engineering. So when we think of this higher risk tolerance and long-term maturity, part of the strategy there is to promote Chinese firms, promote Chinese corporations internationally. So compared to Western finance, right, that often has, even multilateral institutions often emphasize bankable projects, right? Policy banks are instead charged with catalyzing finance and strategic credit spaces, right? Creating economic activity in risky environments. Of course, this risk appetite's not limitless, right? We've seen as policy banks have had high exposure in places like Venezuela and Pakistan, they've also been willing to unwind it as well. But on net, relative to the Western benchmark and Western financing, it tends to be more risk tolerant. Now we can look at the following graph, just as an example of this. This is China's FDI into Brazil, right? And I had mentioned, right, that China kind of uses its finance in order to help create sort of market share internationally. So it might come in and help finance infrastructure projects, but simultaneously, the hope is that multiplies into more trade, more FDI, and more economic activity. So what you see happening here, every time there's a dip, right? Global financial crisis in Brazil, Brazil's economic crisis and commodity downturn, Rousseff's impeachment, and the Lava-Jato scandal. What ends up happening essentially is every time China's investors are buying on this dip, right? This shows you sort of the way that there's an incentive to buy these cheap assets during downturns, right? Where comparatively, oftentimes, Western capital's exiting during these downturns. Now, another key feature, the third feature, I mentioned two, long-term maturity, as well as sort of a risk tolerance. There's also sort of non-conditional lending. Of course, I put the question mark here because compared to Western lenders that have policy conditionality, we have China emphasizing its principles of peaceful coexistence and emphasizing non-intervention domestic affairs. As mentioned before, they're using these policy bank loans as a way to maximize markets rather than individual profits, right? So rather than thinking about macroeconomics and policy conditionality, they're much more likely to think about commercial conditions that help maximize their market share internationally. So what do I mean by commercial conditionality, right? Because essentially I'm highlighting as a trade-off, right? With Chinese loans, you get more fiscal space, less policy conditionality, but comparatively, more commercial conditionality. So what happens here? Well, there's two aspects of these commercial conditionality, right? First is more of your kind of tied aid traditional approach, right? Where China's trying to, with these loans, have guaranteed contracts with Chinese firms, contractors or suppliers, commitments to buy Chinese machinery. So for example, if China invests in locomotives abroad, or if they're investing in, hydroelectric plants, right? That investment, that bank financing helps create export opportunities for things like turbines, right? So there's this export promotion element to it, market promotion, firm promotion element to it, but there's also sort of a alternative way of hedging financial risk, right? I like to think about policy conditionality as a way, right, to hedge credit risk. Comparatively, right, if China's not going to have policy conditionality, they have to have some other way of hedging their risk. So this is where sort of guaranteeing loans with either future commodity deliveries, right, or natural resource guarantees. This helps ensure, from their perspective, that loans will be repaid in the future. However, another element, right, in these contracts, as just mentioned, are this fine print, right? Oftentimes, transparency of these contracts is not terribly high, and there's concerns about, okay, what does the fine print say? How much Chinese content is guaranteed in this project relative to local content, right? So an example is in Argentina with its cargo railway, you had a supplier contract that about nearly 100% of it went to China, right? This gets renegotiated over time, but the point is that you can have sort of almost like a trade deal, right? This infrastructure financing ends up quite often being about local content. And then sort of the key part too, in order to hedge risk, is the notion that, okay, if China makes this loan, to give a little more detail about these future commodity deliveries, China makes a loan to a country like Ecuador, you'll have exports sent to Chinese importers of oil, and the proceeds will be put in a bank account within Ecuador, and the government will use proceeds in that bank account to repay its loans, right? So this structure effectively ensures, right, there's money via sort of these oil sales to repay the loans, and simultaneously gives China often sort of a preferential access to repayment through these accounts as well. So why would this be important, right? Why do we care, right, if all of a sudden China's financing a greater share of countries' external debt? Well, here we see, right, in a place like Latin America, you have bonds outstanding, which was a traditional way of financing debt for many countries, particularly throughout the 2000s, as well as multilateral loans. And we see this falling off, right, throughout the mid-2000s there. And comparatively, this dark line on the bottom is China's bank loans as a share of GDP. And you see that's increasing relatively. And as that happens, the argument I make is that that's going to give countries more room to maneuver. Why? right? There's less of that capital exit that I mentioned before. China's lending is likely to be long-term. It's likely to stay around longer. That gives governments more opportunities to spend, right? Comparatively, private capital is more likely to exit more quickly. And as it does, that creates a fiscal constraint on governments. Now, China's loans too, oftentimes they get characterized monolithically, right? As being just state to state. But an important part of China's financing is that there's also market-oriented loans. Part of what I do in the book is I develop an index that differentiates the state-to-state loans from more market-oriented loans, right? Where a government through procurement process, maybe certain Chinese firms are going to bid on infrastructure projects, but that financing is going to go directly to the corporate sector rather than state to state through development projects. So this is important where Latin America historically, many of these loans have been state to state. You have about 10% of these loans being more market oriented, but it's going to create variation by country in terms of this argument about fiscal space. Just as an example, let's go to Argentina shortly, right? Argentina, we have loans to the state-to-state channel, such as hydropower station loans in Santa Cruz. Here, we have direct contracting with Chinese banks, right? Argentina, even though it has laws saying you need to have private procurement or bidding from the private sector anytime there is government contracting, if you get concessional financing under Article 5 of Law 27, they can contract directly. So Argentina provides a state guarantee to this loan. And as this happens, about 23% of the loan is paid for directly with Chinese machinery and equipment such as turbines, as I mentioned before. But a big share of that loan, about 77%, is also funneled to pay for fungible civil works project, right? Which allows for more spending discretion. So you have sort of this element of state-to-state financing and more spending discretion mentioned before. Transparency also ends up being oftentimes with the state-to-state channel, more opaque. So, for example, there was a Supreme Court legal ruling in Argentina because of concerns about the environmental sustainability of these hydroelectric projects. They put a stay on the commercial project because they wanted to get a better understanding for what the costs were environmentally and see through bargaining if it could be improved, right? This would happen when the Macri administration came in back in 2015, ends up ultimately, through this renegotiation, reducing the number of turbines and generating capacity in order to make it more environmentally friendly. So you can see state-to-state channel increases discretion, while at the same time also sort of increases state indebtedness and reduces transparency to some extent. When we comparatively have loans going through the private channel, such as Cachari Solar Park in Argentina, we have a privately managed auction system. This one is Renovar. We have a company like Shanghai Electric Power Construction winning a bid for $390 million for the solar park. However, the loan flows directly to corporate enterprises that win the bid, as mentioned before, rather than the Argentine government. So you don't get that same spending discretion. You do have China Export in Exim Bank coming in with preferential export buyers credit. That's a fancy term for concessional, not necessarily concessional, but below market financing in order, right, for firms to use Chinese machinery and equipment. So you still have that tied aid, that commercial tied aid to some extent, but you don't have that discretion that we talked about previously with the money going directly to the state, and you don't have the same extent of state indebtedness. Transparency, on the other hand, ends up being higher, right? So as part of the procurement process, there had to be local community consent. Folks received training to work in the plant, construction and operations, even participate in profits according to provincial law 5915, right? So that is kind of the difference between these two channels and why it can be so important to think about what channel China's financing is going through. Let's look at the effect of the state-to-state channel. I made the claim before that as money goes state to state, you end up having greater fiscal discretion. You can see just by the stylized facts here, China has greater bilateral credit as a share of a country's total external financing. The primary budget balance starts to deteriorate, right? As you move from below 5% all the way through greater than 35%, right? Comparatively, to kind of then look at some statistics and compare it to Western financing and some of those sources I'd mentioned earlier. When China's state-to-state finances extended to countries in Latin America, on average, fiscal deficits get higher, as you could see, both when normalized by debt or normalized by GDP. Comparatively, look what happens, right, as the share of bonds to debt or GDP increases, or as the share of multilateral loans to debt or GDP increases. You tend to get a statistically significant and positive relationship, meaning you're more likely to get increases in budgetary surpluses or a narrowing of deficits, right? The exact opposite pattern there. So this again shows how China's financing can lead to more fiscal space, more policy space. Here again, across many different models, you have that similar effect where China's bilateral financing enhances primary budget balances, primary budget deficits, and hence enhances fiscal space. Here's a descriptive, right? Just to kind of look at some descriptive statistics across Argentina, Ecuador, and Venezuela. You see a similar sort of trend, right? These are all leftist governments too, by the way. Throughout the 2000s, they have budgetary surpluses, right? Notwithstanding, right, the fact that you have many regimes that would prefer to spend more money and redistribute if possible. What ends up happening, they're very reliant prior to the global financial crisis on financing from the markets or financing from Western multilaterals. During the 2008 downturn, many of these countries had built up savings, government savings, so they had money to spend during the downturn. But at the same time, you could see this blue financing is China's financing, right? So even though you get this initial counter-cyclical response, you get sustained budgetary deficits throughout the next decade once you have China's financing, right? So that's, again, making the argument as the share of China's financing is larger, it allows countries more fiscal space, and particularly countries that might want to have greater redistribution, might want to have more balance sheet maneuverability, but couldn't previously have more fiscal space. Now, I mentioned the importance of that channel, right? And the importance of the market channel. Brazil, as we know, is a lot more reliant on other financing flows, right? From the market, multilateral institutions, large country, big private sector. Here you see, right, even a country that wanted more fiscal space, right? Certainly, right, going into the 2014 election, we know Rousseff wanted more fiscal space, right? Kind of tried to tinker with fiscal discretion within Brazil in order to get more fiscal space. You also then, following that, have a period where Brazil's undergoing crisis, both economic and political. You would imagine, right, there's an incentive to spend, but because of, I would make the argument, because it's so reliant upon market financing, private sector financing, both in Brazil and beyond, you end up getting spending capped during this period of time, right? Even Petrobras, right, that ended up borrowing some funds directly from China, in terms of overall discretion, right, didn't give Brazil that much discretion, right? And in general, because public procurement is constitutionally guaranteed in Brazil as well, your flows tend to be oriented towards the private sector, and financing tends to go directly to the private sector, leaving countries like Brazil less room to maneuver. So I've not first explained to you the importance, we have about 10 minutes remaining. I first explained to you the importance of policy conditionality, right? So the benefit of Chinese loans ends up giving cheap infrastructure financing to many developing countries and more fiscal space, more policy space. But right, there's also some conditionality that's still associated with this, right? Even though there's not policy conditionality, there is what I call commercial conditionality. As mentioned before, commercial conditionality can have different characteristics, right? It can be bilateral tied aid. It can promote China's foreign content, right, through locomotive sales, through cheap capital inputs, through turbines for hydroelectric plants, right? All kinds of promotion of China's firms and exports in this way. Can also have commercial interest rates, right? Sometimes we see variation with this. Sometimes China goes in to a country like Venezuela, gives preferential rates in order to expand its share in the energy market, right? Initially in sort of the late 2000s. But comparatively, other countries like Ecuador got market rates, right? Or rates that were a lot closer to the market, right? So sometimes you get development rhetoric surrounding these, but those interest rates don't always have to be preferential, right? There can be variation in there, and that's something that countries also have to be wary of. We also see currency promotion, right? That effectively we see, Bill and I were even talking about this before the talk today, right? Lots of central bank swaps in the region. What that does, even though Latin America is a region with lots of commodities settling in dollars, it helps advance sort of the framework for renminbi internationalization eventually, right, through these currency swaps. Even in the CELAC agreement this past January, we see an emphasis, right, on using renminbi for local settlements, right? So this is also a long-term goal. Promoting Chinese commerce helps promote the renminbi ultimately as well. So those are the commercial elements of commercial conditionality. But also make the argument that there are elements of this commercial conditionality used to manage sovereign risk, right? So of course, one way is via administrative channels, right? With a country like Argentina, there are cross-default clauses in these loans, meaning I mentioned earlier that Argentina put an environmental stay, right, a legal stay on those hydroelectric plants in the south because of concerns about environmental sustainability during the Macri administration. What ends up happening in response to that? China has built in its contracts cross-default clauses, meaning if China if the hydroelectric project doesn't move forward, China won't finance other projects in the country, including a cargo railway that's really important to Argentina's development. So you have these structures across default clauses, right? Again, oriented towards ensuring, repayment of debt for China. But then how did they follow up with this? Administrative channels, right? Letters between the two governments highlighting the importance of this cross-default clause, right? So China also puts a lot of emphasis, not surprisingly, on these administrative channels of commercial diplomacy. You also have, mentioned earlier, commodity guarantees with commodity-backed loans. What happens here essentially is, as mentioned before, right, a country will sell its exports, its natural resources to China, take those proceeds, put them in a bank account, and use that to repay its loans. That helps China not only ensure that there's money to repay back its loans, but it also helps China get preferential treatment, right? A lot of these bank accounts are dedicated to repaying Chinese debt, meaning if there's some kind of debt sustainability problem, right, the proceeds go to China, right, not somebody else. There's also state-backed commercial insurance from Sinosure that is oriented towards helping manage this risk as well. Here's an example of cross-default clause from Argentina case that I just mentioned as well, sort of a common feature of these loans too. Now what I do is actually look at, before we looked at policy conditionality, now I look at commercial conditionality, right? I've made the argument that China is more likely to rely upon commercial conditions to hedge its risk. Now in this graph, you see the black is China's corporate financing as a share of GDP. The gray is China's state-to-state financing as share of GDP. Below, along sort of the axis, we see zero conditions. The one is for firms and machinery, kind of traditional, right, tied, kind of aid tied loans. But the two is for these commodity-backed loans, right, or natural resource guarantees. And what we see is as state-to-state financing increases, right, the amount of commodity-backed loans or commodity guarantees also increases over time. You can see it here in this correlation. As China's state-to-state financing increases as a total share of a country's Chinese financing, you get more and more Chinese commercial conditions, right? So this is China's way of hedging risk. Okay, so when we look at this, ultimately, we've highlighted there are benefits and costs to China's financing, right? The benefits are long-term financing that might even better align with the region's development horizon, right? One of the challenges for countries in Latin America historically has been they've been relying upon short-term finance for development. There's a market downturn, economic downturn, that money exits and constrains what countries could do from a policymaking standpoint. So it's been positive in that way. It's also been positive in terms of infrastructure deficits, right? During Latin America's period of austerity into the 90s, right? Basically what happens during that time, it's very difficult to cut social spending, pensions, education. And when you do, people hit the streets. Comparatively then, it was a lot easier to cut infrastructure. So what ends up happening is Latin America has more and more infrastructure deficits over time. just think about Latin America's investment was a mere 0.6% of GDP in the 2000s compared to 3% rates in 1980s. So when China comes along with its infrastructure financing, right, this is really a good match in terms of a region and many countries in the region that really want to have infrastructure investment in infrastructure, right? We see governments from Argentina to Brazil with major infrastructure packages that they want to finance, right, in order to be more publicly accountable and more order to deliver key public goods to its constituency. But of course, China's financing, like any form of financing, also has costs. And those costs reflect this commercial conditionality, right? If loans are tied to Chinese firms, products, and machinery, then just like trade agreements, right, Latin America was put in a position it needs to negotiate for an increased share of local content. Sometimes, right, with locomotives, for example, with railroads, a country like Argentina doesn't produce locomotives. So, okay, import China's, locomotives, no big deal. But in other sectors, right, there's a very, there's a well-known Argentine industry for sleepers or railroad ties. The first time it negotiated this agreement with China, all of that local content went to China. There ends up being a renegotiation down the line with releases of new tranches, where instead there's much more a focus under the Macri government of renegotiating that local content, providing opportunities for Argentine industry within that sleeper sector. So that's one key thing to think about in terms of costs. There's also a middle income trap, right? Many countries in the world, right, are concerned about industrial upgrading. And this is a key feature of China's Latin America Development Plan. But to date, only 1/10 of China's FDI has been destined for the Latin American manufacturing sector. And 2/3 of that has gone to Brazil, right? So we see a lot of promises about increased industrial upgrading, increased fostering and manufacturing opportunities within the region. But the most progress has been in places like Brazil. We still need to see sort of more progress elsewhere in the region. There's also the question of, as China exports labor-intensive manufacturing to places like Africa, we know labor costs are pretty cheap. Region like Latin America has higher labor costs. It might not be so easy to export that low-intensity manufacturing. There's also, of course, the extent to which all this is used to essentially guarantee loans, right? And you have all the sale of oil exports and natural resource exports to China to guarantee these loans. That raises the question of commodity dependency, right? So, for example, under the Cruz administration, when Ecuador got more degrees of fiscal maneuverability, more degrees of fiscal space, right, to spend, they did that by leveraging 4 years of natural resource exports to China, right? So there are these developmental costs that could reinforce commodity dependency too. And then finally, from an indebtedness standpoint, right, you have a lack of policy conditionality, which allows countries to have more fiscal space. But if you have governments that don't sort of think about spending prudently or economically, or more likely to spend politically, or more likely to orient itself towards rent seeking, well, that could create moral hazard, right? Where you have greater balance sheet expansion that leads to greater indebtedness without greater growth, right? And we've seen this in places like Venezuela. So we have about a minute left, so I can always go through some of these slides later. But what I want to do now is just then speak for my final moment, my final minute here about what China's doing, right, prospectively, right, given these patterns I've highlighted. So what we've seen essentially is that the character of its investment channel has started to change over time, right? I mentioned the state-to-state loans and the more market-oriented loans. In light of this increased indebtedness, in light of some of the state-to-state risk we've mentioned historically in places like Ecuador and Venezuela, we're seeing, right, since 2014, China has set up state-backed private equity funds where they can invest directly in equity rather than debt financing to try to mitigate some of this exposure. We've also seen them diversifying exposure away from sovereign governments to the firm level through an emphasis on procurement as well. I mentioned before, I said, just like in its domestic development, China has an array of tools, right? And likes to use those tools in certain circumstances, right? And so when it goes into countries that have big procurement systems, like Brazil, it tends to focus on procurement. So also, I think there's more and more focus on procurement and PPP coming from China as well. One key note about these state-backed equity funds is they have invested in Argentina, Brazil, Peru, and Jamaica. But compared to the big headline numbers, they've only deployed about $2 billion in Latin America as of 2020, or 5% of China's capital, overall capital, has 5% of the overall Chinese capital committed to these funds. Finally, the last point here is increasingly what we see, I think even with the BRI forums, there's a big difference, right, over time in the priorities of President Xi in talking at these BRI forums. They become more and more, there's more and more emphasis on multilateralism, right? So we see new investment partners over time, not only China's commercial banks, but multilateral institutions like the World Bank and the Inter-American Development Bank, and even local development banks, right, to share investment burdens over time. Within CELAC this year in January, we saw a lot of emphasis on multilateralism, right? And CELAC is a multilateral forum to promote infrastructure, right? So we're starting to see a shift in solely focusing on the bilateral elements of the relationship and increasingly to the multilateral elements. Finally, AIIB is operating with private procurement through international bidding, just like, right, the World Bank. And so those two channels I mentioned before, we're starting to see more and more market-oriented stuff come through as well. They signed, for example, cooperation agreement with the World Bank. And we've seen to date the AIIB tends to have governance principles that are pretty similar to the World Bank as well. So with that, I'll leave you with the following, right? I mentioned that there's this trade-off between policy conditionality and commercial conditionality. Generally, countries get more fiscal and policy space when borrowing from China, but the potential cost can be, right, greater indebtedness, right? And what we've seen happen over time, right? China has these commercial guarantees to try to hedge its position, promote its commerce, and manage this financial exposure. But as the exposure to some countries like Ecuador and Venezuela got high for those countries, China found itself in a defensive lending position, ultimately having to restructure in countries like Venezuela, Ecuador, even more broadly in countries like Argentina as well, and Bolivia too. So thank you very much, and I look forward to your comments and questions.
Thank you so much, Stephen. So just a reminder, please enter your questions in the Q&A box. I think we have time for at least two, possibly three rounds of questions. I'll give you a few at a time that I've fielded here from our participants today. The first one comes from Rodrigo Mora, a PhD student at the University of Essex. And Rodrigo says, thanks for the talk, loved your book. Have you seen instances of China using its clout as a creditor over Latin America in ways similar to the economic coercion reported in cases of trade and investment elsewhere? And Jerry Harris from the Global Studies Association asked, what is the effect of China's commercial conditionality on local sourcing and building a local industrial base? How about we start with those two?
Great. Yeah, thank you very much. Thank you for your questions. I appreciate it. I'm glad you enjoyed the book as well. So the first question about economic coercion, essentially, right? So in the press, there's kind of been a lot of focus on weaponized interdependence today. So the question essentially is, okay, how likely is China to use economic interdependence in this way? I think it's sort of, at times, as I mentioned, there's a preference for administrative channels, and some of these contracts have these cross default clauses, right? So I think that China's careful to try to hedge its risk in this way, so it has tools to manage indebtedness, right? It doesn't have policy conditionality. It has research, right, elements of these development bank that might say, here are the best policies. The countries don't have to follow them, right? So they do use some of these economic tools in order to ensure that the projects move forward. So we saw this actually in the case of Argentina, ironically, because there was so much local content with the cargo railway, right? The cross default clause was put into that to ensure that the hydroelectric plant, right? It wasn't necessarily to ensure that the hydroelectric plant got built, which was more of a, you could label a prestige project, right? Comparatively, it was much more important to get that local content for China, or that Chinese content with the cargo railway, right? So you get that cross default clause. It happened that, things ended up, they had to be much more concerned about that hydroelectric plant given Argentina's environmental concerns, but then how is it dealt with? through the state-to-state channel, through the cross-default clauses, where Chinese diplomats basically tell the Argentine president, listen, if you don't move forward with this hydroelectric plant, we won't move forward with the cargo railway or any other financing in your country. So they do use sort of these tools that are embedded in the contract in that way, undoubtedly, but that's not all they're doing, right? Like any country, it toggles between carrots and sticks. Then in terms of commercial conditionality, right? With the second question, can you remind me of it too, with commercial conditionality?
Yes, the second question was, what is the effect of China's commercial conditionality on local sourcing and building a local industrial base?
Yeah, so that's a key question, right? And I think this is, like I said, right, China is using both carrots and sticks. And there's a realization from China's perspective, from a development standpoint, that countries in Latin America want to avoid the middle income trap. They're concerned about the level of capital inputs. So China has promised greater manufacturing coordination as well. Now, to some extent, right, I think in countries with big markets, as I mentioned before, like a Brazil, we're more likely to kind of have synergies, right? Where you have investments in auto, manufacturers from China that simultaneously then may source locally, right? But I think that's sort of a limited example, right? I think there's intentions to have that kind of deepening of a manufacturing base in the long run. I think the kind of language that China uses is very similar at times to UNDP about the importance of industrial guidance, importance of industrial deepening. So China believes in these things. But as I mentioned, so far, they've been much more likely to pan out in places like Brazil relative to other countries. What we do see in a limited basis with the vaccine diplomacy in recent years is some emphasis in local production as well. But those are also kind of in earlier stages of formation.
Great. We'll get a few more questions in here in this next round. The first question is from Yan Wang with the GDP Center. Do you think that patient capital is not limited to China, but to all of East Asian economies because of the long-term orientation rooted in Confucian culture? And so East Asian countries then all have patient capital. What are your thoughts on that? Additionally, we have a question from Rebecca Ray with the GDP Center. Thanks for a great talk. How do you see this finance relationship evolving in the near future? As debt renegotiations are currently ongoing with Ecuador and Argentina. And we'll get one more in from Zara Albright, a PhD student working with us. I'm curious to hear more about Latin American views of this trade-off between policy conditionality versus commercial conditionality. We know that many LAC countries have become frustrated with this policy conditionality from Western multilaterals over time. Do we see similar reactions starting in response to commercial conditions, or do you think that we will in the future?
Great. So I'm going to go backwards. So I'll start with sort of the question about, there's this trade-off between policy and commercial conditionality. We know countries have gotten frustrated historically with policy conditionality. Do we start to see frustration building with commercial conditionality? Through my research, I actually have seen, I often make the point that we shouldn't think about China monolithically. We also shouldn't think about countries within Latin America monolithically. And even in the executive branch, I've seen tensions over time, right? Where the finance ministry might negotiate the deal, right? And the finance ministry gets maybe concessional interest rates, right? And a really good opportunity. Think of something like Argentine nuclear power, right? Where, there's been concessional financing to expand China's market share. And then the government, ultimately thinks, this is really good because we're able to essentially get cheap financing for projects. This is great. But then historically, countries like Ecuador in particular, right, there might be differences between a planning ministry and the finance ministry. Finance ministry secures these deals, but then planning ministries say, well, wait a minute, why don't we have technological transfer in these deals? Why don't we negotiate for more local content? So I have seen those kind of patterns emerging even among the executive branch, where depending upon what your constituency is in your particular ministry, you may feel very differently about those loans as well. Then we have sort of Rebecca's question as well. Thank you very much. In terms of, as we see this ongoing restructuring with Ecuador and Argentina, what's happened with the nature of the financing moving forward? Well, as the GDP Center has well documented over time, we've seen the scale of these loans, new loans, right, trail off. And I think that reflects some of this increased debt burden and concerns about the increased debt burden. Of course, this debt burden is not only China. Countries like Venezuela, you have Wall Street, lots of other participants. That should be emphasized as well. This isn't just China. But I think what you see instead is then increasing emphasis on other tools, right? And even other sectors. So when we're talking about things, such as those state-backed private equity funds, they're entering into like agribusiness, right, on an equity level in order to mitigate risk. We've also seen with COVID diplomatically, right, some of these tools are similar, but we're seeing a shifting in terms of future orientation being in sectors like telecom and 5G. That's something that was mentioned quite a bit in CELAC as well. We know vendor financing has been really popular in places like Brazil. China comes in and offers financing in exchange for using China's telecom networks, 5G networks from Huawei and others. So I think that you see this patient capital still operating, but right, it's shifting into more an equity focus, which takes away some of this fiscal discretion, importantly. And then simultaneously, it's also increasing and orienting itself much more into the future in terms of other sectors. Now, I should emphasize there's still a big infrastructure emphasis. CELAC also mentioned the importance of infrastructure moving forward. Finally, in terms of the first question, patient capital, is this unique to China, right? Or is this just East Asia? Well, one of the reasons I named the book Globalizing Patient Capital is this very much, right, what China's doing, right, has a unique China element to it, but it also, right, its sort of historical dimension is very much based upon the East Asian model, right, where we see industrial guidance, we see investment in infrastructure historically, and we've seen a lot of successful development domestically within East Asia as a result of this. What I think is unique about China is the extent to which and the scale to which it's taken that model and oriented itself internationally, right? Particularly using state-led financing. Oftentimes in other East Asian countries, right, there's been more of an emphasis on private bank capital comparatively. So I think that that's an important, unique aspect to China's investments internationally. But then to even speak more broadly, I think patient capital, right, in some ways, I view it as a broad category, and China's investments overseas is a subset of that, right? But you can make an argument, right, even in terms of the United States or developed country, the extent to which a, individual household saves education for the future, right? That's a patient capital investment, right? You're investing the future with a focus on development, your household development over a long period of time. Similarly, even the Defense Department, something like DARPA in the United States, right, you can consider to be patient capital because it has a much more longer term orientation. That being said, I would make an argument that there are sub-dimensions of patient capital. And right, what also made China unique was this risk tolerance, right? I think it had very high risk tolerance, particularly as it enters market initially. They use this cheap financing as a way to break into new markets and expand China's commerce internationally. I think that's what's been really unique about it. And then the final element, policy conditionality, or the lack of policy conditionality, the emphasis on non-intervention is an important developing country principle dating back to the Badu Conference of the UN in the 1950s. But again, I think China's been the first to kind of really aggressively promote that with its financing on an international scale.
Great, thank you. We'll get one more round of questions in here. Another question from Rebecca Ray is that Western IR academics are often trained in great power, balance of power frameworks. How might a reliance on these frameworks leave observers less able to understand and interpret the nuance of what makes Chinese financing different and sometimes more attractive to LAC countries? Abdul Sufi from Madison, Wisconsin asks, do Latin American countries require Chinese FDI to provide their technologies to the host country government? And I'll add one last question in here. Obviously, China is strategically using its lending as part of this foreign policy toolkit, as you discussed. But China has also chosen to pass on opportunities to deepen debt relationships with certain countries. And the calculus doesn't always seem to be because there isn't, a resource that it can extract. So can you discuss a little more Beijing's political calculus and how that might be shifting as we approach this new post-COVID-19 era that's going to continue to be defined by high levels of indebtedness in low and middle income countries?
Great. So I'll go sequentially this time, starting with Rebecca's raised question. Terrific question. Thank you very much. Great power competition in IR. And I sort of similar to the framing of Rebecca's question, I'm reticent about sort of the implications of these models in the sense that a lot of them based upon, diminishing power differentials between countries expect conflict, right? So embedded in those models is kind of a deterministic outcome in terms of conflict, which makes me a little concerned, particularly at the kind of implications that our security community might come to when they're primarily looking at these economic relationships via security lens. And so I think this nuance is incredibly important because it allows you to differentiate areas, right, like public infrastructure that may sort of have public good effects for lots of different countries, Western countries, United States, everybody, right? If Argentina builds a cargo railway, China's not the only one to benefit from that, right? Many developed countries will benefit from that as well. But maybe other sectors, such as telecommunications, there might be kind of a clear, cost benefit structure given some of these security concerns, right? Where maybe the distribution of telecom networks, great, but maybe there has to be, in terms of some of these data concerns, some nuanced thinking there as well. But I think that's very different, right? That kind of sectoral differentiation based upon an economic relationship compared to making sort of grand strategy calculations based upon China's primary way, right, of interacting globally, which is economics, and coming to the conclusion that narrowing GDP differentials will automatically lead to conflict. I'm very circumspect about that, very concerned about that. So thank you for that question. In terms of, technological transfers, right? I mentioned from a development perspective, right? This is just like trade agreements, right? Where countries really need to push harder for local content. We've seen variation a long time. So for example, as mentioned before, right, there's been some reflections in places like Ecuador that, wow, we should have pushed for a lot more in terms of technological transfer. We haven't gotten sufficient amounts. We've seen that pattern change over time in places like Argentina, not sufficient local content, right? The protected labor, but less so some key sectors. That shifts over time. But then we see places like Brazil that's been a little more able to negotiate for technological transfer. And even Argentina, right? That nuclear deal, essentially compared to investments by Western companies like Westinghouse in nuclear power plants in Argentina historically, now you have sort of this potential deal that would reflect our Chinese financing, but also Chinese technology, right? So there's a technological transfer there, but there's also still, right, that tied aid element, because ultimately China is going to expand its nuclear share, right, if these deals ultimately go through, relative to other countries, right? And it's trying to expand that share in order to be more competitive with countries like Russia. Finally, there's this question of, I think, sort of the outstanding debt, right, in COVID times. There's a lot of different dimensions of this question, so feel free to follow up if you had a sort of if I don't hit the exact right element. But one thing I think is really important in terms of this outstanding level of debt is how China characterizes its debt, right? So we have a lot of multilateral frameworks that have been set up to deal with rising level of indebtedness in COVID times in developing countries, including the Debt Sustainability Initiative, right, DSSI. However, an important part of China's lending to Latin America involves China Development Bank. China Development Bank is considered to be a quasi-commercial lender by China, right? So importantly, what that means is that it falls out, from China's perspective, it falls out of the scope, right, of these agreements, right, DSSI, et cetera. That gives China more flexibility to negotiate bilaterally, right? And more flexibility, to wait in terms of writing off loans, right? They may be eventually forced to write off some of these loans, but it gives them even more time, right, to be a creditor, right? Just like we saw from a lending perspective, it could be patient, can also be patient in terms of a writing off perspective, right? As we see even domestically, there's often evergreening of loans waiting till things get better, right? Restructuring until sort of the environment gets better rather than writing off. CDB can do something similar with its bilateral loans and its negotiations as well. So it's renegotiated loans in places like Ecuador, and actually even invested new money in places like Ecuador, but you don't see them necessarily writing off in large scale. One consequence of all this may be, they may be forced to eventually write off more in terms of these loans, and increasingly forced to turn more to multilateral initiatives and turn more to the IMF, some of which we've seen already.
All right. Well, thank you so much to Stephen for sharing his wonderful book with us today and for a really informative Q&A. And thank you to everyone who joined in the discussion. This talk has been recorded and live streamed to YouTube. So we will share the link in the chat and you'll be able to revisit the talk. To receive updates on our publications and events, you can subscribe to receive them in your email from our Global Economic Governance Initiative. There's a link that's been placed in the chat for that. Thank you all, and thanks to Stephen, and we'll see you next time.
Thank you very much for having me too. It's terrific Q&A.
Thank you.